Hello everyone, today I want to talk about how the US is relying on stablecoins and crypto to stay afloat, but this could trigger a crisis at any moment. Also, setting up factories in the US can cause major disasters. Just look at Intel, they can't turn things around. Meanwhile, American car makers are looking to set up parts factories in China instead. We said before that Trump acts without thinking ahead, never considering the negative side effects that might come up. Now, all of this is actually happening. Trump has always claimed that tariffs are a cure-all. They can bring industries back to the US, and you don't even need to hand out subsidies like Biden does. Just waving the tariff stick is enough to scare people. But is that really the case? The US imposed tariffs on China, so China fought back by restricting exports of rare earth products, including rare earth magnets. And then, some unexpected consequences showed up. According to a Wall Street Journal report on June 4th, with China restricting the export of rare earth magnets, American car manufacturers are worried that their production lines could soon come to a halt. Sources say that 4 major US car manufacturers are now considering workarounds, like moving part of their production lines to China, for example, producing electric motors in Chinese factories, or shipping US-made motors to China to have the magnets installed there. According to insiders, moving certain production lines to China is basically a way for car manufacturers to get around China's export restrictions on rare earth magnets. That's because the export ban only targets rare earth magnets themselves, and doesn't cover finished parts like motors that already have these magnets installed. The Wall Street Journal reported that if American car manufacturers really do move some production lines to China, it would be an unexpected development in the trade war started by US President Trump. That's because Trump's original intention was to bring manufacturing back to the US. A supply chain manager at a car manufacturer said that, due to the Chinese ban, the rare earth magnets they purchase currently can't get approval for export to the US. But if they can prove that the magnets have already been installed in China, inside the motors, then they can be exported. Of course, if American car companies ship semi-finished products halfway across the world to China just to install rare earth magnets that are only the size of a piece of chewing gum, it will end up increasing both costs and production time. Although after the phone call between the Chinese and US presidents, China started granting export permits for rare earth magnets to 4 American car manufacturers, in the long run, US car companies still have to consider whether to move their motor production lines to China. Because the Trump administration is unpredictable, if they come up with something new and start another trade war with China, and China once again stops exporting rare earth magnets to the US, the outcome for American car companies could be disastrous. Actually, China is using the same approach as the US. The US imposed a chip embargo on China in this way, so for Chinese companies to get high-end chips, they also need approval and permits from the US government. So just because there's a permit today doesn't mean there will be one tomorrow. It all depends on the state of China-US relations. Now, the situation with rare earth magnet exports is exactly the same. Who would have thought that the US imposing tariffs on China would actually make American companies consider moving part of their production lines to China? In fact, setting up factories in the US is extremely expensive, and simply raising tariffs isn't enough to bring factories back. Just look at Intel's disaster and you'll understand. The 2025 Fortune 500 list in the US has been released. This ranking is based on company revenue, not on their profits. Apart from seeing how Alphabet, Google's parent company, leverages technological innovation to reap digital dividends, we also see how companies like Intel, which are undergoing transformation, have to pay a hefty price for it. It's really not easy to set up factories and produce in the US. On the Fortune 100 list, there are actually 42 companies that made the list but still haven't turned a profit. They're still losing money. And the company with the biggest loss is Intel. Last year, its losses reached as high as $18.76 billion, mainly because of its investment in wafer foundries in the US. Intel used to be the global leader in the semiconductor industry, dominating the market for personal computers and graphics chips. A few years ago, Intel started a reform aiming to rebuild chip manufacturing foundries in the US, largely because the US government encouraged and subsidized them to do so. However, operating factories in the US is extremely costly, and the wafer foundry sector is highly competitive, with Intel facing intense pressure from strong rivals like TSMC and Samsung. TSMC, with its advanced process technology and highly efficient production capabilities, plus the relatively low costs in Taiwan, has become the top choice for many chip design companies worldwide, dominating the main market. Meanwhile, Samsung in Korea has also been ramping up its investment in the wafer foundry sector, and since costs in Korea are also lower than in the US, Samsung has managed to secure a significant share of the market as well. In comparison, Intel's wafer foundries in the US have made relatively slow progress in terms of technology, and their production costs are high, so they've been struggling. Wafer foundries are both capital and technology-intensive industries, and they're actually considered one of the easier types of manufacturing to set up in the US. For example, TSMC can send a large number of Taiwanese engineers and even technicians to help out at their US plants, which already makes it one of the easier industries to set up factories in the US. But even Intel is having a really tough time running similar factories, which just shows how difficult it is to do manufacturing in the US. On another note, I want to mention that a large amount of US Treasury bonds will mature in June, and there are signs that the US-China tariff dispute is easing, which gives a bit of support to US bond issuance. Now, the US is also planning to use another method to forcibly create some demand for US Treasuries. However, this approach also comes with its own risks. This is about using stablecoins in the cryptocurrency space. Recently, U.S. Treasury Secretary Bessent suggested that stablecoins could become new buyers of U.S. Treasuries, which could help ease the problem of a lack of buyers for U.S. debt. With U.S. Treasury yields soaring, the fiscal deficit worsening, and the dominance of the U.S. dollar weakening, these issues have recently become hot topics in the market. However, as the traditional financial system faces challenges and cryptocurrencies are on the rise, stablecoins within the crypto space have been growing at an astonishing pace. According to the latest figures, the transaction volume of stablecoins in recent years has already surpassed $28 trillion, not only exceeding the combined transaction volume of Visa and MasterCard, but also quickly becoming a key pillar of the global digital financial infrastructure. The Trump administration in the US has been strongly supporting stablecoins and is speeding up the legislative process for the Stablecoin Act. Their motives have attracted a lot of attention. Recently, Taiwan's Industrial and Commercial Times published a special feature explaining how stablecoins operate. Simply put, stablecoins are a type of cryptocurrency, but with relatively low volatility. Their prices are usually pegged to major currencies, such as the US dollar. Compared to highly volatile cryptocurrencies like Bitcoin and Ethereum, stablecoins have much smaller price fluctuations. They are usually backed by asset reserves, such as US Treasury bonds or fiat currencies like the US dollar. This allows them to enjoy the advantages of blockchain technology in cryptocurrencies, enabling fast circulation in the virtual world, while avoiding the drastic price swings typical of traditional cryptocurrencies. Back in the days when it wasn't easy to convert funds into virtual currencies, buyers could first exchange their cash for stablecoins, like USD stablecoins, in the crypto world, and then wait for the right price before buying Bitcoin or other cryptocurrencies. Currently, the mainstream stablecoins in the market, such as Tether, USDT, and USD Coin, USDC, are reserve-backed by fiat currencies and are pegged to the US dollar. The issuers claim that for every stablecoin they issue, there is one US dollar or an equivalent asset held in reserve. This reserve is usually audited by independent third parties to ensure that the reserves are real. When users buy stablecoins, the issuer will deposit an equivalent amount of fiat currency, such as US dollars, into a bank, and at the same time issue the same amount of USD stablecoins to the user. On the other hand, when users want to exchange back to US dollars, the issuer will destroy the stablecoins and return the dollars. Stablecoin issuers mainly earn profit from the interest rate spread. Stablecoins mainly operate on decentralized networks using blockchain technology. Not only are they widely used in cryptocurrency trading, but they are also gradually being applied to various fields such as trade, lending, and cross-border payments. Its transaction costs are relatively low, and since it doesn't go through banks, it's less subject to regulation and harder to track. According to the latest report from Deutsche Bank, the size of the stablecoin market has surged from hundreds of millions of US dollars in 2020 to $246 billion as of this May. Since 2020, the trading volume of stablecoins has skyrocketed by 598%, reaching $27.6 trillion just last year, surpassing the total transaction volume of Visa and MasterCard combined. As global demand for US dollar stablecoins keeps rising, the issuers of these stablecoins have to hold even more US dollar reserves. And a large portion of these massive US dollar reserves will eventually be invested in highly liquid and relatively safe US dollar-denominated assets, which of course includes US Treasury bonds. That means the booming stablecoin market is actually creating an increasingly significant new source of funding for US Treasuries. According to a survey by Deutsche Bank, the amount of US Treasuries held by the issuer of USDT, Tether, has skyrocketed from almost zero in 2020 to an estimated $98 billion this year, accounting for 81% of its reserve composition. In addition, as much as 83.5% of fiat-backed stablecoins are pegged to the US dollar, which means that stablecoin holders are indirectly or directly holding over $120 billion in dollar reserves. This means that the global development of stablecoins is actually continuously absorbing US dollars and firmly anchoring them within a US dollar-based digital asset ecosystem. It's foreseeable that as the stablecoin market continues to expand, the demand for US Treasury bonds will also rise accordingly. Stablecoin issuers are the new buyers of US Treasuries. According to forecasts by financial institutions, by 2028, the scale of stablecoins will reach $2 trillion, absorbing about $400 billion in US Treasuries every year. In addition, amid the global wave of de-dollarization, stablecoins have the potential to allow the US dollar's influence to continue in the digital era. U.S. Treasury Secretary Blinken made it clear at the White House's first Digital Assets Summit that they will maintain the U.S. dollar status as the world's leading reserve currency, and use stablecoins to achieve this goal. To sum it up like this,